Okay, well this is back to a traditional style. So any faults will be purely my own and not the fault of the Central's Wi-Fi system. This is sort of an attempt at a sort of, if you like, a balancing presentation in that Paul is obviously, the sensible money proposition is obviously putting forward a particular potential solution, potential approach. And I just wanted to take a quick look at what other people's responses to the monetary dysfunction look like. Because although there's quite a shared, what should we say, a shared sort of narrative of the problems, at least within a certain group of commentators, there are quite wide diversities in terms of what the responses that they're suggesting are. So first of all, I just wanted to run through some of the basic problems, sustainability problems of the current money system. Now, today's reading is taken from Money and Sustainability, the Missing Link. I can refer you to chapter and verse. This is a highly recommended publication from my point of view. That's, I think, one of the best narratives of the current problems and so on. And it's actually put together by Bernard Littard, who we're hoping to Skype in, although, well, we'll see. But basically, each of these could be the subject of a conference in its own right. I mean, the fact that the money is created in a pro-cyclical way, in that during the boom, the banks sort of follow themselves into in a sort of herd mentality in creating money, and we're awash with money, and during the bust cycles the reverse happens, and so on, which, as we said, is good for intermediaries and people buying and selling at the appropriate parts of the cycle, but is not great for stability or sustainability. The fact that the whole thinking is based on a short-term horizon, both politically and commercially. The fact that we need unending, continual growth in order to justify, to create the money to repay the compounded interest that's going on, and so on. The fact that the wealth is progressively concentrated in the hands of smaller and smaller groups of people, the sort of inequality that Michelle was talking about, and the devaluation of social capital, where we can find competition overwhelming cooperation. Now, in all of those cases, I mean, there's probably a conference to be run in each of them, looking at the causality. In other words, to what extent does the design or the implicit design of the money system contribute to each of those negative effects? And that's part of the challenge for something like today, because we simply don't have time to do that. We may not have the intellectual resources to do it, but we certainly don't have the time. So the bottom line is that money isn't a neutral facilitator. The textbooks say that it's a neutral facilitator of exchange. It's just a number. It's just a way of facilitating exchange between two parties. But it does carry explicit and implicit values, and a lot of those values are negative. I guess it's been a success, I guess you could say, in that as an invention, money does allow individuals and businesses to trade with each other when they don't know much about each other, and so on and so forth. It is, I guess you could say, a successful invention, but it seems to be an invention that's on the verge of outgrowing its usefulness. So what do you do as an activist? Not everybody can be or wants to be an activist, I think, but there are a couple of schools that it's worth commenting on. One is the whole area of what I called monopoly reform via policy change. This is actually recognizing the fact that the private banks have a monopoly in the creation of money and looking to reform the way that monopoly operates, put it back in the hands of the government, and maybe possibly. But there's also a whole slew of opportunities to create and adopt alternative money, alternative currencies. So what I'm going to do is do a little bit of comparison between those approaches. They're not mutually exclusive, I don't think, except to the extent that we only have so much energy and so many hours in the day to work or to be interested in these sort of things. But I don't see them, I don't think it's helpful to see them as competing approaches, but they're just different responses to the perceived dysfunction of the monetary system. So if we are comparing, we're trying to be kind about it. I'm not trying to torpedo anybody in particular. Monopoly reform is an umbrella term, if you like, for positive money, for sensible money, for the MMT way of looking at the world that Emu was talking about. And at its heart, if you try and sort of synthesize out the common approaches, it involves a repatriation of that money issuance to the government, and the government then would spend, not lend that money into circulation. But a key part of that is the claim, if you like, that by redesigning the monopoly in this sort of way, or bringing it back into the hands of a democratically elected government, that you would improve the first use of capital. You'd improve the first use of funds as they are loaned or as they're spent into the economy. And the argument there really is all about the misallocation of capital that is the proponents of this approach would say is obvious from by the banks. The new Chicago plan, the original Chicago plan was thinking along these lines in the 1930s by an economist called Fisher. The new Chicago plan was a term that was coined when one of the slightly contrarian thinkers in the IMF came up with a paper a year or so ago revisiting this type of approach, which has been seized on by some of the activists as a sign that the tide is turning, if you like, for these rather radical ideas to take root in the amongst the policy changes, the policy definers. And the claims that are made for this approach is that it's the only way that our current debt, huge amounts of debt, could possibly be orderly liquidated, and that it facilitates a road towards full employment, which is both heresy, I think, in terms of orthodox economists. But it's a politically coloured debate because the right thinks you can't trust the government, the left thinks you can't trust the banks, and a whole load of people, probably a lot of them in this room, thinks you can't trust either of them. The right-wing view would preach to us the efficiency of markets. That's the only way to allocate capital. You shouldn't try and second-guess the marketplace. But I think we know that there's hardly a market that can't be rigged. It's just, and if you think you've found a market that can't be rigged, it's probably because you don't know enough about it. Another view from the right would be that there's a danger that because when the government takes back control of the currency, it would print money to buy elections and so on. These are all, reasonable points to make from these particular political standpoints. From the left, they would point at the greedy monopoly misuse of that power to create money by the banks. The money that they make, the seigniorage, the money that they make out of being able to issue this money for themselves is essentially an unearned right. If I borrow money from another business, then arguably that business has earned it and through the sweat of its brow or the cleverness of its ideas. And you could argue that by giving up the right to spend the money now and giving it to me for a period of time, it should actually get some return on its investment. But the banks have never actually done that. They get that right on making money out of the interest by being essentially given that right by the government. They didn't earn it. And that the amount extra money that's actually washing around as a result actually encourages progressive financialization of the marketplace. We know that of the transactions that are going on now, some enormous proportion, 80 or 90% are actually financialized transactions. They're nothing to do with the real economy at all. And the fact that the banks can easily lay their hands on this excess, on this ability to create money, means that they're tempted all the time to create money into speculation, into gambling. So we're in this situation where the real economy is being operated from a small corner of the casino. And misallocation of capital, we already talked about. It's worth looking at a little bit more. If you've effectively got unlimited money, okay, there perhaps are limits on the money, but they're certainly not because of the reserve ratio and the capital adequacy requirements and so on. But there's huge amounts of money can be loaned into use, but of that huge amount of money, only about 10% is loaned into an investment, is actually into investing into a business that wants to invest. It's loaned into consumer purchases for us to buy a load of stuff we don't need. It's loaned into assets to create bubbles and to bid up the price, as has already been described very well this morning, of mortgages. It's used to create leverage buyouts so that big inefficient companies can buy out small efficient companies. And it's used for speculation. The 700 trillion, I don't know, choose a number. These are numbers that are, beyond my comprehension. But what the original idea of sort of hedging instruments where businesses sensibly insure against future risk, for example, for grain prices or something like that. That use of financial instruments has been completely overwhelmed by the speculative use of those sort of things. One of the presentations I was at in London last week was from somebody looking at the impact of this sort of activity on food, on food futures. And again, I don't have the exact numbers here, but from being something like 10% speculation and 90% proper hedging of risk, in about 7 or 8 years it switched to be the other way around. So it's now sort of 90% speculation and 10% hedging of real risk. And as somebody's already said this morning, the banks lend on whim or on sentiment. The limiting factor on how much money is in supply is what the banks feel. What they actually feel at the moment, whether they're talking as a group or whether they're watching what their competitors do or whatever. It's not based on any really solid parameters. That herd mentality feeds into a pro-cyclical sort of boom and bust scenarios. Their risk assessment, I think it's pretty clear it's poor, and it's been said that it creates rather than manages risks. The way they actually allocate capital, the way they analyze risk against different sorts of loan opportunities is badly flawed. And there's no credit guidance. There's no strategic approach. There's no recognition of what a national strategy might be in terms of spending this or loaning this money even into circulation. So even if a government's got policies, they're irrelevant to the allocation of capital. And credit guidance is something apparently that did exist up until the 1950s. In other words, there was a degree of not control, but of guidance in terms of, if you like, quotas, both the quantity and the quality of the capital that's allocated. I'm not sure if Paul's going to talk about the capital allocation or not, but certainly Positive Money's idea is that you separate the quantity of allocation from the quality of allocation. Now, so that one group would say how much money you need into circulation from a sort of macroeconomic point of view, and another group would actually direct that in terms of price to circulation from a sort of macroeconomic point of view, and another group would actually direct that in terms of national priorities or whatever. Now, the criticism of this sort of approach, which I've called here the New Chicago Plan, which you can read about on page 128 of our Bible, is quite an interesting set of criticisms. To me, the most compelling one is the idea that a monoculture carries, doesn't matter whether it's privately or publicly owned, it carries its own instability. And that in nature, for example, nature doesn't select entirely for efficiency. It selects for a mixture of efficiency and resilience. And if you get a totally monoculture efficient organism, then it's not resilient. It's not very resilient to disruption or to changes. And at a sort of an emotional level, I think that's it feels like a strong argument for multiple currencies and multiple approach. There have been criticisms about the inflation risk, although, as I said this morning, I think the link between the money supply and inflation is much less direct than traditional orthodox economics would have indicated. It doesn't prevent monetary crisis, but it does address, because it doesn't stop an individual money supplier or monetary system getting into crisis by being mismanaged, but it does address all the sovereign and banking crisis. The most depressing reason cited, I think, is political realism. In other words, that the vested interests of the banks are so strong that you'll never get this idea adopted. This is rather a depressing critique of the approach. And finally, the risk of doing something on a big scale, and that a change of this nature has to be done on a very big scale. It can't be done, you can't fiddle around with it. It has to be done fully committed and on a very big scale, and the risk of unintended consequences. Now, all of those deserve more time than we've got. On the advocates of this approach would, as I say, would support multiple diverse currencies. They would anticipate a degree of Darwinian competition between them and endeavour to take the hindmost. There was quite a famous paper by an economist called Hayek in the 60s or 70s, I think, which anticipated competition between currencies, I think in a rather more limited way, with just specific banks issuing it and so on. And perhaps it's a revisit of some of those ideas. But the difference this time around, certainly from when some of the ideas were mooted in the 30s, is the internet and the fact that a lot of the new currency developments we're talking about are digital currencies. And those digital currencies have the ability to evolve very quickly. And therefore, that sort of the idea of a multiple monetary ecosystem might actually be more easily imagined today than it would be in the 30s, when everything was sort of paper and community-based. But it does have issues, this approach. Can you scale these currencies up to a level where they're having the effect that they are setting out for themselves? Can they get critical mass? Will you ever get the government to accept them in payment for taxes? Because if you don't, then these currencies are competing with the existing fiat currencies with one arm behind their back. And another criticism is they're not suitable for Armageddon, but then not a lot is really. This is on the basis that they're electronic, and when things go pear-shaped and we retreat to our sort of cabins in the Wicklow Hills, that internet currencies are not going to be much use. Finally, I just wanted to look at the idea of designer currencies, because designer currencies to me just takes this whole thing just one step a little bit further along the way. It's saying that if it's not going to be a neutral means of exchange, then we might as well be explicit as to what we expect out of the currency, what we want out of the currency, and how we design it. And some of the parameters of that thinking might be to recognize very clearly what the core function of that currency is. Is it more to do with providing a means of exchange or is it more to do with store of value? Again, we probably haven't got time to go into the detail, but there is a degree of tension between those two functions. You want enough currency around so that people can actually achieve the transactions that they're minded to take on, but not so much that it sort of devalues quickly. A second parameter would be what I'd call the preference domain. What domain do you want that currency to work within? What's the scope of the currency? You tend to think that that would be a geographic thing. Is it local, national, international, or whatever? It could be a geographic thing, or it could be a shared interest thing. I mean, there's no reason why the preference domain couldn't be everybody in the arts world. I mean, anyway. So, but that's a design, potentially a design choice. And as I said, if you can't be neutral, what's wrong with rewarding specific behaviours and outcomes that you're seeking to achieve? And I think one interesting way of thinking about this whole area is to ask whether all transactions are equal or not. You know, again, in traditional economics, all transactions are equal. There's no difference from a money point of view. There's no difference for them. But for me as an individual, then there is a lot of difference between what I've called the stuff of life transactions, you know, to do with food, shelter, energy, clothes, whatever, versus things that are nice to have. There's a real distinction between the real economy and the financialized economy, where that tail of the financialized economy is wagging the dog of the real economy. Some transactions have low embedded energy, low energy implications. Some have high energy. Some are eco-friendly, some are eco-damaging. Some have a short and long supply chain. Brian mentioned the fact that it's no good having, well, I wouldn't say it's no good, but a local currency is only part of the solution when a lot of the ability to fulfill, to provide goods and services have been strip mined out of local economies into the centre. And that, you know, unless you're actually, if you're implementing a local currency, unless you're actually finding a way of building that the functionality of that local economy back up again, you've only got half of the picture. That's really pretty much what I wanted to talk about. I mean, this is a deeply unsatisfactory slide, really because, you know, I have a view that it's not fair to expect everybody to be activists. It's not, you know, people have their own imperatives. They have their own priorities and so on. And although I think that education is a very important part of the equation, I don't think we should expect everybody to have the level of interest that the people in this room have. So, you know, so this is a so what, as we say, for the less committed. You know, yeah, okay, it is deeply unsatisfactory because I can't think of enough options, really. But move your money, move your pension, take control as far as you can, get rid of intermediaries when you can, disintermediate your investments. And in terms of investments, look at utility and forward revenue streams for yourself and your family, rather than more distant recommended investment choices. And lastly, you know, if you've got the time and the energy, participate in experiments, especially if you can see that there's an attempt for the governance of those experiments to be democratic or to be transparent in the way that they operate. That's it.